Due diligence, your M&A lifeboat. Mergers and acquisitions can be lucrative. They offer the potential for significant growth and expansion, opening new markets and opportunities. But they're not for the faint of heart. Due diligence is crucial. It's the process that ensures you're making a sound investment. Think of it as your lifeboat. Just as a lifeboat is essential for survival in stormy seas, due diligence is essential for navigating the complex waters of M&A. It helps you navigate the treacherous waters of M&A. The business landscape can be unpredictable and full of hidden dangers. You need to spot the red flags before you're knee-deep in a bad deal. Don't skip this step. It's your first line of defense against potential pitfalls. It's your money on the line. Every dollar invested is a dollar that could be at risk if you don't perform thorough due diligence. Diligence means asking tough questions. It's about digging deeper than surface level information. Dig deep into their financials. Scrutinize their operations. Understand their legal standing. Look at their past performance and future projections. Talk to their customers and employees. Get a sense of the company's culture and reputation. Don't just take their word for it. Verify everything. Cross-check information from multiple sources. This is about protecting your investment, ensuring that your money is going into a stable and promising venture. A little caution now can save you a lot of pain later. It's better to be thorough and cautious than to rush and regret. Remember, in the business world, hope is not a strategy. Due diligence is. It's the cornerstone of a successful M&A strategy, ensuring that you make informed and wise decisions.
Financial quicksand. Spotting a sinking ship. First, look at the financials. This is the foundation of understanding a company's health. Are revenues declining? That's a big red flag. A consistent drop in revenue can indicate underlying issues that need immediate attention. It could signal deeper problems. Check their cash flow. Cash flow is the lifeblood of any business. Is it consistent, or are there irregularities? Consistent cash flow is crucial for sustaining operations and growth. Unusual patterns could mean trouble. Scrutinize their debt levels. High debt can be a significant burden. High debt can limit their growth potential. It can also make the company vulnerable to economic downturns. Watch for unexplained expenses or sudden jumps in profits. These anomalies can be red flags. These could be signs of financial manipulation. Remember, numbers don't lie. Always verify the data. If something seems off, it probably is. Trust your instincts and dig deeper. Don't be afraid to walk away from a bad deal. It's better to be safe than sorry. There are plenty of other fish in the sea. Opportunities are abundant, so don't settle for a sinking ship.
Legal landmines. Don't step on these. Legal and compliance issues can blow up your deal. Do your due diligence. Investigate their legal history. Are there pending lawsuits? Have they been involved in any significant legal disputes in the past? These questions are crucial. Have they had regulatory run-ins? Any history of non-compliance with industry standards or government regulations can be a major red flag. These are major red flags. Examine their contracts. Look for any unusual clauses or terms that could pose a risk. Are they airtight, or are there loopholes? Loopholes can be exploited and lead to significant legal troubles down the line. Look at their intellectual property. Is it protected? Ensure that all patents, trademarks, and copyrights are properly registered and enforced. Don't underestimate the importance of compliance. Regular audits and reviews can help maintain compliance and avoid legal pitfalls. make sure they follow all applicable laws and regulations. This includes local, state, and federal laws, as well as industry-specific regulations. Failing to address legal risks is a recipe for disaster. It can lead to costly lawsuits, fines, and damage to your reputation. It's like playing with fire. Ignoring these risks can result in severe consequences. You're bound to get burned. Always be proactive in identifying and mitigating legal risks to protect your business.
Unhappy customers, unreliable tech, recipe for disaster. Customer satisfaction is paramount. Unhappy customers mean trouble. Check their reputation online. Read reviews, scour social media. What are people saying?
Assess their technology. Is it up to par? Outdated or unreliable technology can be a drain on resources. It can also hinder growth and innovation. In today's digital age, technology is king. Don't partner with a company stuck in the dark ages. Look for companies with a proven track record of customer satisfaction and technological prowess.
Strategic misfits, like oil and water. Even with solid financials, the deal can still sour. How? Strategic misalignment. Your companies need to fit, like pieces of a puzzle. Do your cultures mesh? Are your goals aligned? Do you share the same vision for the future? If not, it's like mixing oil and water. It just won't work. Before you sign on the dotted line, make sure you're on the same page. A clash of cultures and conflicting goals will only lead to friction and failure.
Financial deep dive. Numbers don't lie. Due diligence requires a deep dive into their financials. Don't just skim the surface. Bring in forensic accountants. These guys are like financial detectives. They'll uncover any hidden problems, analyze historical data, project future performance, look for trends, both positive and negative, understand their financial health. This is where you separate the contenders from the pretenders. Remember, knowledge is power. The more you know, the better equipped you are to make an informed decision. Engaging stakeholders. All hands on deck. M&A involves more than just numbers. It's about people. Engage with key stakeholders early on. This includes employees, customers, and suppliers. Communication is key. Be transparent about your intentions. Address their concerns. Build trust and rapport. Remember, a smooth transition depends on their buy-in. Ignoring stakeholders is a recipe for disaster. It can lead to resistance, delays, and even sabotage. Keep them informed and involved throughout the process. Communication is key. No secrets allowed. Throughout the M&A process, communication is paramount. Keep everyone in the loop. This includes your team, their team, and all stakeholders. Be clear, concise, and transparent. Don't leave room for misunderstandings. Address rumors and speculation head on. An informed team is a confident team. Lack of communication breeds mistrust and uncertainty. It can derail even the most promising deals. Riding the waves of change. Adapting to market trends. The business world is constantly evolving. Market trends shift like the tides. To succeed in M&A, you need to be adaptable. Don't be afraid to adjust your strategies. Be open to new ideas and approaches. What worked yesterday might not work tomorrow. Flexibility is key. Companies that can adapt to changing market conditions are the ones that thrive in the long run. Remember, in the world of business, the only constant is change. Embrace it. Are you ready to unlock the full potential of your business and captivate prospective buyers? Imagine having a clear, compelling analysis of what your business looks like to a discerning purchaser, highlighting its strengths, addressing its challenges, and showcasing its future growth. This isn't just about numbers. It's about telling the story of your hard work and dedication in a way that resonates with buyers. Don't leave this critical step to chance. Schedule an initial consultation at www.jamesmontgomerylaw.com and discover how a comprehensive business analysis can transform your selling journey. Let's take this pivotal step together and make your business sale as rewarding as your entrepreneurial journey.